Well, hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, life insurance with living benefits, part 4 of our series on basic financial solutions with financial advisor and president of the Society for Financial Awareness, Jim Chilton. Welcome to the show, Jim.
Thank you.
Segment 4, we're talking about life insurance. Now, this is not your grandfather's life insurance, right? This is living benefits. I thought, when I think of life insurance, and I know my consumers do, they go, hey, this is death insurance.
Right.
But now they're attaching all sorts of morbidity riders for, health, for cancer. It could be riders for all kinds of things, long-term care, disability, terminal illness. They have a lot of different types of benefits now attached to it. They're living benefits that you can tap into that big death benefit and get it paid down to you, and sometimes, depending upon the tax situation, free. Let's talk about what is it. Life insurance, we pretty much know it, but just make sure you touch it. And then let's talk about living benefits and why people are doing this more and more. Why it's so important.
Sure. When we take out a policy, we basically know that there is term insurance and there's cash value insurance. And then you can get into universal life, variable universal, I got all of that. Just stay with me on this. There's term insurance or cash value insurance. You pay a premium. Somebody dies, the money is usually paid because it's purchased usually with after-tax dollars. The person dies. The receiver is the beneficiary for the business partner or in the home. And that's what we know of life insurance. Charlie gets carried out the next day. You're sitting there looking over the wall saying, I hope they had life insurance. Okay. So the idea is I've been a financial advisor. I'm coming up on 37 years.
Wow.
One of the issues that I've always had is my fear is I spent all my career helping to build your assets to be liquidated for your kids' college. I build your assets through an income stream for retirement and so forth. And either you or your lovely wife takes on dementia, bad type of cancer, renal failure of your kidneys, blindness, paralysis, some awful kind of cancer, as I said, a stroke, a massive heart attack. And here's the important part. You didn't die from that right then. So to the one who's healthy, the nightmare begins. Liquidation of assets. Now, how many people can liquidate their term insurance and get a nickel? None. How many people can go into their cash value and use the cash? Most. But how much really is in there? If you're talking about like Bill O'Reilly would say, the folks, the average person, there's not much money in there. But what the insurance company realized is what happened if we took the big number, the death benefit, term with no money in it, but allowed you to go into the death benefit or the death benefit of the cash value. Not the cash value, but the death benefit. That would be paid out, the proceeds. I think I misspoke. Not the cash value, but the death benefit, the proceeds. And accelerated out when that awful tragedy, happened.
Now, in these contracts, Jim, are they charging for these ancillary living benefits?
Well, as you know, I come over to your studio here in Arizona. I live in California. Okay. We only have currently 2 companies. It's not appropriate to get into that, but we have 2 companies that offer it. Both companies at this time, looking back on the 3 years that my wife and I took out these contracts, those riders are free. They still, in June of 2017, are not being charged.
It's just part of the overall contract.
It's just part of the premium. Okay, now I think another major point to realize is I don't want you to think that, oh, I'll go get that rider over here from XYZ Life Insurance and add it to my ABC policy. Doesn't work that way.
No.
I came home after at a conference listening to this and told my wife, and we're parents of 5 kids, and I'm getting rid of all my insurance. And she goes, no, you're not. I said, no, you need to hear me out. We're going to redo it. We're going to get the same insurance, or maybe even more, and we're going to have living benefits. And we did that. So we pay a regular premium like we always did. But these living benefits were very beneficial, and it was a game changer in my own home.
Now let's talk about your own, because you said we could. I'd like to talk about your own personally. How much was your wife into working out, diet? Talk about.
Let me give you the 2 titles of her profession. She's a personal trainer. I think she's got maybe 1% body fat, maybe. Okay, no, obviously not her husband. Okay, 1%, and she's a health coach.
So she's in spectacular shape.
If any of your viewers, if we march Pam in here, you go, oh no, there's no way in a million years that she would have a stroke.
But she had a stroke.
She had an ischemic stroke, not a TIA, an ischemic stroke, which the easiest way it is, it's the blood clot stroke. The one that you're all paralyzed and you're done is the hemorrhagic brain bleed. Pam did not have that. She had a blood clot. Okay, and the gift of God was the fact that there's only one place in your brain, your front right lobe, that if you have it in that one spot, the area around it, teamwork, it all fills in within 60 days and takes over the dead spot.
Wow.
Amazing. So it happened. Well, she had her stroke at 6:15 in the morning on a Monday, and the great financial advisor didn't realize till Wednesday in the afternoon of the same week, I have a policy for this. So I looked into it. So we had to have, obviously we had to report, get all the APSs, attending physician statement. We had to get that from the neurologist and her primary. And it was about 45 days after the stroke, all the data went into the insurance company, and we got back a check for $602,000 that came from the rider that was free. And then I held my breath till this April 15th and never got a 1099 because it's considered an advance. It's an advance against the death benefit. You got it?
Yes.
So it was accelerated out, the death benefit, purchased with after-tax dollars, no harm, no foul. My wife is 100% back, and we got $602,000. That's the closest we'll ever come to hitting the lottery. But I want you to understand, if you go, well, he probably has an expensive policy. No, I don't. No. And that contract on my wife, Pam, was on 20-year level term insurance. Very reasonable. I paid in, I think it was about $9,100 for 3 years for my wife's coverage and got back $602,000. You're the investment guru. How's the return on that?
Pretty dang good.
And my wife is 100% back to work.
Now, I want to ask you a question on this. For most people that are buying a plain 20-year term, we're not talking about anything extravagant here.
Exactly.
And you're getting a free rider, and you say, hey, put that on there, right? I'm willing to have that rider. 600 grand would have sunk 90% of middle America. You had a 600 grand bill for a kind of a stroke like that, you'd have been done. That has sunk your ship.
Without a doubt.
Without a doubt.
She was in the hospital for 5 days, and the bill was close to $300,000.
5 days.
Yeah, but let's not forget again, back under the P for protection, my medical with my deductible and everything, I had to come up with $6,100 to meet the 80-20 and whatever, and it was a $300,000 expense that came in on my deductible. It cost me $6,100. But on my life insurance, protecting, walking the talk, instead of just talking it, the rider was free. I put in about $9,100 over 3 years. We got $602,000. Now, her mom died of dementia. So let's say that Pam never had the stroke. You got it? So let's say it's hereditary, and Pam goes into some form of dementia in her 70s, or Alzheimer's, or Parkinson's. It's good. The policy is still there to pay the money on that claim. Do you realize the fine line now between a long-term care insurance of pay the premiums, nothing happens, and the money's gone? This, with the odds of us being gone in death, is 100%, but we still have medical issues, don't we? That it's covered. So you might want to rethink your positioning of your assets when it's always just got to have long-term care. This living benefit thing, I mean, after that happened to the financial advisor's wife, okay, I have a good friend that his wife had invasive breast cancer. Okay, and I remember I called Art back and I said, it was an invasive? He goes, oh yeah, it was in there. It was a lumpectomy, they took it out. They got $292,000. And she was in her first year of the premium. She was 7 months into the premium and it paid off.
So you believe?
Oh,
okay.
I ask everybody, do you have the new or the old insurance? And that's where it starts.
Wow, well, don't forget to watch our next segment on Your Financial Advisor Must Be an Educator, part 5 of our series on basic financial solutions. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money, the name of the game.